Let's dive right in. Today, we're unpacking a highly anticipated intelligence report from the Upside Journal. We're getting into exactly how cross-border payment architectures and multi-currency rails are completely reshaping African financial markets. We're talking about massive shifts here, real structural changes in financial inclusion, liquidity management, and institutional investment. Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing. To do that, we've put together a really precise investment briefing docket for you today. We're going to systematically deconstruct this macroeconomic thesis across 4 acts. Number 1, the VC paradox of 2026. Number 2, asymmetric information and operational moats. Number 3, the climate tech supply chain edge. And finally, number 4, the repeatable flywheel framework. All right, let's get to work. Kicking things off with Act 1, the VC paradox of 2026. We really need to contrast the legacy rails with the modern ones. Look at the sheer delta in operational efficiency here. We are anchoring this directly in World Bank data, which shows that legacy correspondent banking channels for sub-Saharan Africa carry an average fee of 9.3%. That is an incredible amount of friction. Now contrast that directly with modern diaspora digital mobile money rails. Those average just 3.54%. And when you look at zero-fee architectures operated by platforms like Lemfi and TapTopSend, that friction literally drops to 0 for the end user. They are entirely engineered for instant low-cost cross-border settlement. And you really have to grasp the sheer weight of the liquidity pool moving through these efficient digital rails. It is absolutely staggering. According to GSMA data, African mobile money transaction volumes hit $1.4 trillion in 2025. Over $800 billion of that was in East Africa alone. So for a fund manager, this isn't some niche alternative strategy anymore. This is the dominant artery of continental liquidity, and you simply need exposure to it. To perfectly illustrate the profound baseline friction that these modern diaspora platforms are finally solving, check out this historical anomaly. In the early days of building Lemfi, the founders figured out that it was actually cheaper to route a remittance from the United States to Africa by sending it through Canada first, rather than just sending it directly. That level of routing inefficiency is exactly what modern API-first architectures are completely eliminating today. Moving right along to Act 2, asymmetric information and operational moats. You see, a payment is never just a payment. It's an onboarding event. Empirical World Bank research analyzing 10,000 households across Burkina Faso, Kenya, Nigeria, Senegal, and Uganda clinically proves this. Receiving international remittances directly increases the probability of a household opening a formal bank account. That right there is the financial inclusion flywheel in action. And this brilliantly illustrates the Upside Journal's concept of the financial infrastructure stack. It starts at the base layer with payments. But once those payments recur, you layer on multi-currency accounts. Through those recurring transactions, you systematically accumulate identity, compliance-grade KYC profiles. That verified identity, combined with transaction history, creates the ultimate alternative underwriting signal for credit. From there, you can intelligently route capital into savings and investment vehicles, and finally execute cross-border commerce and trade finance. The operators actually winning this space? They're totally bypassing Western legacy intermediaries altogether. Nala, for example, built direct API integrations with M-Pesa in Kenya. Chipper Cash engineered an architecture for instant intra-African peer-to-peer transfers. So sending money from Ghana to Nigeria doesn't have to route through London or New York anymore. By controlling the direct integration, they seamlessly accumulate verified talent and transaction data. That creates a massive, highly defensible operational and regulatory moat. Which brings us to Act 3, the climate tech supply chain edge. Let's look at the infrastructure under the hood. To actually execute high-trust, cross-border deal flow, you need a very clinical, technical sequence. First, you need API-first bank integrations that allow platforms to talk directly to local financial institutions. Second, dynamic foreign exchange routing to aggressively manage those currency pools. Third, automated compliance layers that instantly verify identity without manual legacy bottlenecks. And fourth, real-time ledger settlement. This exact machinery is what allows diaspora payment networks to evolve way beyond simple consumer transfers, moving straight into institutional-grade capital routing.
And just look at how liquidity management is actively evolving right in front of us. Utilizing Flutterwave metrics from early 2026, we're seeing a massive shift. 43% of sub-Saharan digital currency transaction volume is now being executed via Web3 stablecoins. Operators are heavily utilizing stablecoin architectures to instantly hedge against local currency volatility and bypass slow traditional settlement times entirely. It's a total game changer.
All right, our final section, Act 4, the repeatable flywheel framework. This timeline really traces the strategic evolution of the absolute best platforms in the market. They don't start as massive networks on day one. They start in the first few months as a single quarter remittance product. Within 1 to 2 years, they establish pre-funded local liquidity pools to bypass correspondent banks. By year 2 or 3, they launch a multi-currency account layer. And ultimately, at year 3 and beyond, they compound institutional trust to become a fully licensed, multi-jurisdictional settlement network. That's the playbook. Now, to maintain our institutional objectivity here, we have to acknowledge that this thesis faces significant structural execution risks. Regulatory fragmentation across borders is a massive friction point. An open banking license in Nigeria simply doesn't automatically translate to Kenya. There are interoperability gaps between competing payment operators. Foreign exchange volatility can seriously erode settlement margins. And finally, trust concentration risk. If a major node in the network fails, the localized trust across that entire corridor can literally evaporate overnight. So, synthesizing this entire core investment argument, there is a fundamental difference between a payment product and a payment network. A true network exhibits persistence over time. It accumulates identity. It facilitates multi-directional flow, not just one-way remittances. And crucially, it has layerability, meaning you can seamlessly build credit and trade on top of it. True infrastructure value lies in this multi-layered data trail, transforming a simple one-off transfer into a highly durable financial annuity. Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to The Upside Journal and join our membership communities. See you in the next Daily Drop. We're going to leave you with this final, provocative question to consider regarding your venture allocations right now. Are you funding single-purpose payment apps, or are you investing in the definitive financial infrastructure of the next decade? Thank you so much for joining us for this explainer.